How's it going, friends and family? My name is Amos. I'm a stay-at-home dad, and I try to upload these YouTube videos whenever I can. So last time we talked, we looked for undervalued stocks based on their price history and performance against the overall market. And when I say the market, I mean in relation to the S&P 500. Like if they were at 14% year to date, and this industry, it was at negative 20% or negative 25%, then it gave me a compelling reason to look into it, whether it's a buying opportunity or a value trap. Now, today, it's going to be a little more systematic and it's going to be predicated upon the numbers. So we're going to be looking for undervalued compounders based on metrics, numbers, financials, and fundamentals. And believe me when I say there's plenty of compounders on the dip right now. And to prove it to you, what you see on your screen right now is a modified version of the magic formula, and it's inspired by Joel Greenblatt, a business professor, but with my twist on it, because I feel like it could be optimized from its original format. And essentially, it helps me to filter for companies that are cheap on paper, but also high quality. Because sometimes a business or a stock, they could have a very cheap valuation, and that's because it's a very poor business operation. So they'll have a trading multiple, otherwise known as the PE ratio, of like a 5 or 6, because the inherent business model itself is dying. Shout out to you, Western Union. That's why it's a single-digit PE ratio. But if the numbers are executing and the valuation is low, then that right there could be the reason for me to investigate further. And between you and me, if a company has a low valuation, but the numbers are declining or decreasing, that's a risk that I'm not willing to take. That's an investment not worth making. And that's why in the stock market realm, they call that a value trap. Because on paper, you're attracted to it because it looks undervalued, but by putting 10 grand, 50 grand into it, it'll eventually get reduced to negative 20, negative 40%, and you'll lose your money. So with the modified magic formula, I only want to take into account companies that are sizable. So over $900 million in their market capitalization. And when people say the market cap, it's essentially the stock price times the amount of shares outstanding. So if it doesn't add up to at least 900 million, ideally around 2 billion or 5 billion, I'm not interested. Reason being is that micro cap stocks, it tends to be really volatile. Meaning the highs are really high, but the lows are really low. So when you think about a mega cap company like Microsoft or Meta, and there's a market-wide sell-off, in Microsoft, Google, Amazon, they experience a 7% drop, micro caps will see a 40, 50% drop. Consequently, I'm just not interested in it. And then because I'm an American, you can call me ignorant, you can call me weird, I try to invest in businesses that operate out of the United States. Yes, there are some high quality compounders that exist in Kazakhstan, India, or Bangladesh. I just don't know enough about those regional differences and geopolitical attributes to take into account. And then the forward PE, essentially being under 19 for me would be solid. Because historically, the S&P 500, I mean, right now it's sitting at a 20.6. So to be at least -1 from that means it's still undervalued in comparison to the market as a whole. And according to Google, the 5-year average for the forward PE is a 19.9. Simplicity's sakes, round up, say it's a 20. So by screening for a 19 or less, it should be undervalued in comparison to the broader market. And then this right here, the ROIC, the return on invested capital, it's the most important metric for me. I have a deep dive video talking about the ROIC and why I care about it a lot if you're interested. But the bottom line up front, if you don't want to watch that video or if you don't have time, how efficiently a company is using its capital when you take into account the loans and the shares outstanding to generate profit. So 10% is the golden standard. Anything less than that, and they need to have a really compelling reason as to why. Maybe it's a one-off thing, but to be closer to 15% would be better. So maybe it's a little harsh to set the metric at 12% or above it, but we're going to leave it alone as is. And then for the free cash flow, I at least want to see it be positive year over year. So once we apply those metrics, we have how many? 224 stocks. So let's change and adjust this to 50 rows. And it looks like they're ranked by market cap. So the most undervalued business operation, according to the modified magic formula, would be Micron, front and center of the SSD RAM memory shortage. And if you take a look at their metrics, it is bonkers. And it almost seems like fake news. Almost too good to be true. And that's because they're going through a once-in-a-lifetime supply constraint where all the hyperscalers, such as Meta, Amazon, and Microsoft, they're building out these data centers and there's not enough memory chips to go around. And that's why SK Hynix comes into the picture, same with SanDisk and some others. I mean, for the free cash flow to grow by 1,200% year over year, that's funny money. But that's exactly what they're executing. ROIC being 67%, insane, a 6.6 forward PE. Then again, you have to keep in mind, when it comes to cyclical stocks, I only take that with a grain of salt. Because what does it mean to be cyclical? It means there's highs and lows, boom and bust, roller coaster rides of the peaks and the valleys. It's not going to constantly rip to the moon. Then it wouldn't be cyclical, correct? And that's why right off the bat, I can tell you for Micron, the investing thesis, if I were to buy into them, it would only be for the next 2 quarters or 3 quarters. But according to Micron and SK Hynix, they're saying that it's going to get even worse in 2027. But anything is up in the air. Maybe Google, Microsoft, and Amazon, they're going to get so fed up of being overcharged for these memory stocks that they're going to optimize their software in order to do more with less hardware. I don't know what's going to happen. So with cyclical stocks, it's hard to bake in the next 5 or the next 10 years of what's going to happen, because for all we know, once the data centers are built out, do they really need to spend an additional $500 billion building out even more? I mean, they probably could, or they probably won't. And according to this website, CleanView, data centers in the United States, last updated, it's up to date. There are 1,284 data centers up and running in the US and 1,900 planned projects. So for the foreseeable future, in the next 2 to 3 quarters, yes, I do think AMD, TSM, ASML, Lam Research, SanDisk, Micron, I think all of them will still benefit because 1,900 are still to be built by Oracle, by OpenAI, Anthropic. There's more money to be thrown into this AI bubble. So how would I play into this boom and bust thing? If I were to invest in Micron, which I don't want to, it's beyond my risk tolerance, I would probably buy the dips and then sell after relief rallies. I think to buy and hold a boom and bust type of investment, it takes a certain type of stomach where you could just go to a third world country, eat some street food that's made with some wastewater in the soup, and you don't even get the runs. No diarrhea for you. You don't even need Pepto-Bismol. If you have that kind of stomach, I think it could work for you. But for someone like me, I can't do it. I can't buy and hold because Google or Amazon rolls out a software update that says we don't need as much, the latest and the greatest, but we could just rely on lesser than the highest quality chips. I'm not trying to say that I have a magic 8-ball, but I can definitely see Micron dropping 20-30% in the red that day and then going into a downward trend. So that's a long-winded way to say cyclical stocks I almost don't want to investigate further into. But the next one that we have is a dividend compounder classic. It's a blue chip household pharmaceutical, Merck. And if you're not a friend of this channel, before I became a stay-at-home dad, I used to work in the pharma industry as a strategy guy. And I went on record by saying Merck is one of the high-quality ones, alongside Johnson & Johnson, Eli Lilly, and there are others not so high quality. But as a whole, it's an industry that I personally wouldn't invest into because the drug pipeline is such a gamble for the most part. Unless your R&D and your scientists and your clinical trials experience no obstacles, then I guess it makes sense. Or if you're doubling down on a very, very successful Hollywood blockbuster drug like GLP-1 medicine to help you lose weight, then yeah, I guess you could buy and hold. But for the most part, I try not to invest in my own former work. But their forward PE being at 15.7, ROIC being 14%, also really good. Free cash flow growth, 9%, pretty solid. Now, moving on to number 3, now we're talking about a company that has my attention, IBM. This is an ancient dinosaur tech conglomerate that just, for one reason or another, they always find a way to stay relevant. Believe it or not, 20, 30 years ago, they used to be the original Mag 7 alongside with Cisco. But anyways, their forward PE is an 18.5, ROIC 14%, free cash flow growth at 12.6%. I think there's a lot to like about this one. Today they're having a red day, but I think the market as a whole is experiencing red. So let's see, we'll just go to SPY. Yeah, so red is not unique just to IBM. And the spread between their trailing 12 months PE ratio 21 to their forward PE being an 18.5, it's not that far apart. So meet in the middle and say something like a 19, 19.5, maybe even a 20. I think when you compare that kind of evaluation to the broader market, I mean, is it crazy to say I think IBM is undervalued when you take into account their future and involvement in quantum computing, especially the manufacturing of said chips? If you're bullish on quantum computing, IBM, I think, has a really, really bright future. But if you're a part of the camp that quantum computing is all smoke and mirrors and it's never going to pan out to be lucrative as a commercial endeavor, then IBM would be a value trap. Me personally, based on what I understand, I'm not a quantum computing guy, but seeing what it can do and the problem solving that it can unlock, I'm bullish on it. I could be wrong. And by the way, I already uploaded a deep dive analysis on IBM a couple weeks ago, and it's still relevant and up to date and current with my thoughts on it. So I don't want to drive my little car into the left lane and go 20 miles below the posted speed limit, okay? So I'll be as honest as Abe Lincoln and tell you that I like IBM. I think they're undervalued. So if we go on back to the modified magic formula, let's see if there's anything else. Number 4 would be PepsiCo, which, as you should all know, main rival and competitor to Coca-Cola. There's Gilead Sciences, another pharma, biotech. And then there's one right here that's worth investigating, Uber Technologies. Forward PE being a 17.8, ROIC 19%, and the free cash flow growth is 18.5%. Okay, so let's look at the numbers and the financials instead of just giving my overview or commentary. So a few things that I want to see. First, the cash flow statement. Obviously, the free cash flow growth is looking phenomenal, but what's more important to me is the trend going up and to the right. It's not just good enough to have 1 year of good free cash flow, and then for the next year for it to just disappear, which is reflective of a cyclical boom and bust operation. With Uber, that's the exact opposite trend. Ever since they became profitable as an enterprise in 2022, it's only been getting better and better. Yes, the growth rate is slowing down because initially it was 700% year over year, which is phenomenal. And then 100%, and then 41%, and then 18%. And if I had to guess, maybe next year it'll shake out to maybe 15%, and maybe that's where that trend will be steady and consistent. But to still post 15% growth in their free cash flow year over year is a good thing. So right off the bat, I can tell you based on how much cash they're actually generating from their operations, me likey. Another thing that I want to take a look at is their PEG ratio, meaning is their PE ratio justifiable by the growth of their earnings, meaning the profits per share and the growth rate of it, does it warrant their valuation of a 16.5, which is really freaking low for a company that I think is very high quality. Now, in the next 10 years, I can't say definitively whether or not they're going to be a dividend compounder because number 1, they don't pay a dividend, but number 2, Google's Waymo might integrate their ride-sharing capabilities into Google Maps, a one-stop shop. Likewise with Amazon and Tesla and whatnot. So there's a lot of variables to take into account. But a 16.5, and we jump back on over to take a look at the PEG ratio, it's a 0.68. Friends and family, when it comes to a growth company, anything less than a 1.7 screams undervalued. Anything less than a 1, even when you take into account mature and established operations like Walmart, or McDonald's, if it's less than a 1, it's undervalued. For a growth company to have a PEG ratio of a 0.7, guys, on paper, they are fundamentally undervalued. And to prove my point, so Uber is diversified in what they do, right? They don't just operate in North America, they also have operations in Europe and in Asia, not only delivering people from point A to point B, but also dropping off your Five Guys overpriced burger to your apartment or your condo, which is the bread and butter of an operation known as DoorDash. They don't deliver people, they deliver food. And if you take a look at their trading multiple of a 113 and forward PE being a 33.7, it just shows you that the market is being way too bearish and the sentiment surrounding Uber is way too negative. Because a food delivering company has the proper valuation, as they should, because they're making a crap ton of money. But for Uber, who's also making a crap ton of money, they're getting punished beyond belief. So according to the modified magic formula so far, I like Uber a lot. But then again, it begs the question, do they have a competitive advantage, an economic moat that is robust and durable against the competition so that your defensive walls, your formation of your infantry can deter the enemy's advances in offense and attacks? When I think about it like that, I can't necessarily say they have a moat that is beautiful beyond description, like reflecting at a painting by Van Gogh. But if I had to give Uber one economic moat, let me look at my little cheat sheet that I have right here. I have a video series that goes over the various economic moats and why they're so important, if you want to give that a watch. I would say for Uber, it would be the network effect. As more and more people have buy-in to the Uber network and there's more drivers and there's also more passengers, it becomes an amplifying effect. So I think they have a network effect economic moat. But at the same time, I want to be cognizant that for most passengers that are not subscribed to Uber's subscription thing, I don't know what it's called, but you can pay a monthly fee to get some perks and benefits. For most passengers, I don't think they really have a preference because most of these drivers, they will literally have simultaneously Lyft, Uber, Grubhub, DoorDash all open at once, and they'll just drive whatever it is. Likewise, in the mindset of a normal passenger, I think they'll open up Lyft and then open up Uber to see which one has the better fare. So Uber, in terms of economic moat, well, hold on. If I take a step back, they also have the scale effect because I do think they're the biggest dog in the fight in terms of the personal transportation landscape. So there are some things to like, but their future, there's also a lot of uncertainty. What I'm trying to say, in the future, if they become a one-stop shop travel platform, kind of like Booking.com, but integrated into Uber's app, where you can do everything when you go travel, your hotel accommodations, your flights, to all of your ride-hailing services to go to the tourist destinations or for business travel, if they become something like that, man, I feel like their valuation should be closer to like a 40 PE, which means right now they're severely undervalued. I guess it really depends on if you feel bullish about them or not. I mean, the numbers paint a picture that I really like. If we take a look at their revenue, I mean, the numbers speak a story for itself, but it's also the qualitative story aspect as well, right? I think you can't go wrong by investing in Google because Waymo is just getting bigger and bigger because it used to only be in like 3 cities, I think like San Francisco, Austin, and Phoenix, but now it's almost nationwide. Likewise with Tesla and what they're doing and Amazon ZooX, the competition is fierce. And at the same time, I'm thinking, why does only one have to succeed? It's not a zero-sum game in that if one succeeds, one has to inherently fail. I do think there's more than enough room for multiple people to benefit. Just like restaurants, there's not just one burger chain that crushes it. There's over like 20 or 30 off the top of my head. Just like the airline stocks, there's American Airlines, United, Alaska. When I think about Uber, Waymo, ZooX, why can't they all succeed and thrive together, right? So I'm bullish on them. I did sell some cash secured puts on Uber, but they're not a part of my portfolio as a stock. And let's do another one, round it out in the top 10. We have Altria. It's a tobacco conglomerate based in Richmond, Virginia, or I think Midlothian. Hold on, I need to figure that out because I am from Virginia slash DC. It is based in Richmond. Okay, that was close. Midlothian is the suburban portion of Richmond. But anyways, taking a look at the Magic Formula Metrics, 11 as their forward PE. ROIC is a 46. Free cash flow growth is small, but it's there. It's still growing. And this is a company that's easily over 150 years old. So it's not a startup. It's not a growth darling or anything like that. It's a blue chip household name that's been around for a really long time. And if we jump on over to take a look at their dividend profile, 4% dividend growth, 6.5% dividend yield. I really like this part, 57 years of growing the dividend despite recessions, craziness happening in the news, and catastrophic events. They didn't cut their dividend ever in 57 years, which I think is really good. And visually depicted, it looks really good as well. Jump on over, just take a look at their balance sheet real quick. $2.3 billion of cash on the books. I don't like the trend going from $5 billion in 2020 down to $2.3 billion, but from my understanding, they did make some strategic acquisitions, meaning they bought out the smaller fish in the sea to strengthen their portfolio. So I think they probably used some cash for that. What's the total amount of loans on their books? Let's see. Total debt is 24.5 billion, and it looks scary at first glance, but the trend of how leveraged they are as a business, it's going down year after year, which is exactly what you want to see. And to see if it's sustainable, due to debt to EBITDA, figure out based on their own core operating profits, how long would it take to pay off all the loans on the books? A 1.5, which means a year and a half. Not bad at all. The golden standard is at least a 3. I think a case can be made that Altria is undervalued and possesses really good metrics. But my whole thing is, if you understand Altria at $65 a share and at a PE ratio of a 13.7, they're actually fairly valued. This is a company that usually trades at a 10 or at a 9. Case in point, if you take a look at their forward PE history, 2020 was a 9, 2022 was a 9, 2023 is an 8. So to have a forward PE of 11.2, like I said, right, fairly valued, maybe even going into that ballpark of slightly overvalued. This is one that I do want to buy. Once again, because I used to own them, I acquired Altria at about $35 a share, and I sold out of them at around $70 a share with the vision of buying back into them once they drop back down to at least 55 or below. At 65, if you buy into them, I don't think it's the worst idea in the world, but can I see them dropping to 55? Absolutely. I can see that happening. Let's go back on over to the modified magic formula. Click on back over here. I guess it would be a good time for us to take a quick break and to give you a little update on the mental outlook. So last week, I went on record by saying like, man, my headspace, not good. Just made a complete transition pivot from Japan to the US, and I'm adjusting to life as a stay-at-home dad, and it's been pretty rough, right? However, since that video was uploaded, I'm not a guy that just sits there and does nothing, right? Because I understand that if you want a different result or a consequence, the input, the ingredients for that formula needs to change. So I cried it out a couple days in a row, which felt really weird. And I'm not saying that because, oh, men shouldn't cry. Oh, crying is weak. Not because of that. It's just when I reflect on my own life, I used to be a crybaby when I was like 3 or 4 or 5 years old at everything and anything. And as an adult, not so much. And then I also stopped feeling sorry for myself, the negative self-hate talk, right? Tried to reduce it as much as possible. And as cheesy as it sounds, I started to say out loud positive affirmations, such as, I can be at peace with my past. I might get excited about the future. I might help someone today. Maybe through my work, my video can impact someone for the greater good. And I use the conditional phrasing because of the cognitive dissonance in my head. Because I have really, really harsh negative feelings about myself. So when I say the positive affirmations that other people would, such as like, I'm happy, I'm grateful, I'm positive, deep down in my heart, I know I'm lying and I can't believe and buy into that. And so, a psychological tip for you, if you're anything like me, you are your own worst enemy and worst critic. That conditional phrasing, a game changer. And believe me when I say it makes a tremendous difference. And other than that, starting this week, I showed up to a random pickup soccer session that I found on Facebook. Yes, even here in the deep south, there are people that really enjoy soccer, which is a relief. Because in Japan, I used to play 3 to 4 times a week. Obviously, before baby girl was born. After she was born, my hands were a little full. But lucky for me, these pickup soccer sessions, they happen in the evening. When the wifey is like, hey, I'll take care of the baby. Go run around and clear up the mental headspace. Because when you're running or doing physical exercise, it's really difficult to be in your own head and to be consumed by the critical thinking or analysis of your past. Because when you're huffing and puffing and it's like 104 degrees and the humidity is just miserable, you can't help but to focus on the task at hand. But anyways, the pickup soccer session, it was kind of crazy because it was 30 African dudes. I'm not exaggerating, from like Nigeria, Ivory Coast, Ghana. And the funny thing is, the way they play soccer is completely different from the Japanese. I think the Japanese do a lot of one-touch passing with the triangle formation, and it's very nimble and efficient, and they drive the ball down the wings. With African dudes, it's a lot more physical and a lot more messy ball. Where like if you get the ball, you do whatever you can and you drive it up the field and you try to score. At least that's been my experience. And I even got a very nice bruise of the ball making a defensive play, and I'll post a photo right here. Dude, even though it's painful, the idea of preventing someone from scoring a goal, I love it so much. But anyways, long story short, I went back out to play with them again yesterday, and it was a full field 11 on 11. And I'm gonna tell you right now, dude, I felt like I was on top of the world. It's like, why didn't I do this sooner, right? Instead of staying in my own headspace and being cynical and complaining and drowning in my own misery, why didn't I go play freaking pickup soccer with a bunch of African brothers? But something specific happened yesterday that made me just feel like I was on the moon. And that's because I played on the left wing. And after a clutch body feint where you go like, you pretend like you're going to go in one direction, but you go the other. And there was 3 defenders on me. And these are big ass African dudes, like 6'2", 180, 220, jacked to the tits. I managed to maneuver past them and I scored a goal with my left foot. And why did it feel so special? Because I'm actually right-footed. So I play on the left wing as an inverted winger. And watching the keeper dive, only to see the ball sneak right past his hands, dude, sign me up. I love that feeling. And to know that I still got it at 35, I'm turning 35 in a matter of months, I was so happy. So freaking happy. Obviously, as I get older and father time catches up to me, I think I'm going to probably transition into being a center back or maybe even as a fullback. But if you play out on the line, you probably run the most. No, that's not true. I feel like midfielders run a lot as well. But anyways, after doing the actionable game plan, which if you're struggling or going through a tough time right now, go and watch that video because it's a play-by-play manual for what has helped me stay out of the dark. And then, of course, playing soccer, I feel so much better. You might be able to see it in my face. I mean, it's early in the morning, so maybe not so much, but I feel so much better. And sometimes when you have all that pent up emotion, you gotta let it go. And when I say that, I don't mean onto others, taking out your anger on them. No, that's a no-no. But rather, figuring out a healthy way to let it out. Whether it's through a craft, whether it's through you creating something like cooking or through strenuous exercise, or in my case, just letting the tears flow, pour on out. Because scientifically, when you cry, you release a lot of cortisol, which is the stress hormone, through the tears and out your body, which is really cool. And amigo to amigo, fully transparent right here, I probably cry only once every 3 to 4 years, so it was probably long overdue. But to let it out, man, it felt so refreshing. And apparently, there's a word for that. After looking into it, it's called catharsis. When you have pent up emotion and you release it, and you just feel relief, a sense of calm and peace and serenity in your heart. So, yeah. And then last but not least, before we hop back into the video and look at more compounders that might be undervalued, I had to put my own life into perspective. So I want to read out loud what I wrote in my journal. I get to spend the first year of my child's life with them every single day. I get to work from home on a creative project that I'm genuinely passionate about and I'm interested in. I don't have to commute. I don't have to sit in traffic. I don't have to sit in an office. I don't have to be in team meetings. I don't have to ask permission to leave. And my work allows me to be flexible and structure my day around my family and especially around my baby's needs. So if you were in my shoes, I mean, would that sound like a terrible life? Probably not. And that's why I'm learning to be grateful for what I've got going on and to be thankful for the person that's watching me through the screen right now, because I'm not stupid or naive. There's hundreds, if not thousands, of other YouTubers that you could choose to spend your time with, but you're kicking it back and hanging out with me. So it just humbles me to know, like, dang, I hope that I can continue to create content that's meaningful for the audience, for folks like you. Now, having said that, before we start holding hands and kissing, which is going to be really weird, don't do that. Let's take a look at what else we've got going on after Altria. We have Adobe, and they've been making a comeback of the century. Like Tom Brady in that one Super Bowl when they were down by, like, what was it, 28 points. And then in the second half, they ended up winning the entire thing, and they became Super Bowl champions. Take a look at them year to date. Obviously, they had a high of around 339, and then they reached the low of about 190. So I think it would be better to just do 1 month. Past 30 days, 15% in the green. So even Adobe, a tier 4 SaaS, that me personally, I wasn't bullish on, I'm actually relieved to see that they're doing well because I know a lot of you are invested in them and I don't want them to do bad because then you would lose money. So I'm happy that they're making a comeback. There's McKesson. They make medical instruments and stuff like syringes and items and supplies that a hospital would use. We have 2 oil and gas players. Their free cash flow growth is insane, and that's because the price of an oil barrel went through the roof. There's Intuit, which is a tier 4 SaaS that I do like, and I kind of regret not investing in them, but I have to give myself mercy and grace. See, I'm trying to be more positive here because instead of going with Intuit, I went with SAP and Microsoft and Amazon. And I think in the end, that was a good decision as well. But for Intuit, I think they're saying the exact same thing as Adobe, 20% in the green past 1 month. Whereas if you take a look at the 1-year picture, it's pretty atrocious, right? They went from 676 all the way down to 252 in the middle of June. So to see them make a comeback, and if you're investing into it, I'm happy for you. I genuinely hope they rip to 400. I don't have skin in the game, but that doesn't mean I can't wish well upon you if you're invested in them, right? Dude, just positive vibes all around. Hopefully we can integrate that into the channel, right? Just be more optimistic, kind, and positive. And then we have health insurance and Cigna. We have Allstate, PayPal, which, by the way, I think they're going to be acquired by Stripe very soon. And I think the buyout price was what, 60, 61, something like that. Currently $59.94. So the upside to their buyout price, not the greatest, but for you PayPal bag holders, I'm happy for you as well. There's finally light at the end of the tunnel. And then there's eBay, which is an e-commerce platform where you can sell your used pair of shoes that you put 300 miles in and it stinks for $20 plus shipping, shakes out to $31.54. eBay. But nah, jokes aside, I bullish on eBay because the younger generation, the folks that are under the age of 26, like who quantifies as Gen Z? Anyways, anyone who's Gen Z or younger, they love thrifting and they love buying used. And so once I noticed that consumer trend, I was like, dude, eBay, I'm very bullish on. Because the whole idea of buying secondhand goods or thrifted clothing, it doesn't have the stigma that it used to in the past. I think maybe even like 30 years ago, people used to think of thrifting for only poor people. But now you'll see the daughters of a Fortune 500 company CEO, her going on eBay to buy a used purse or used pair of slippers. Yes. However, the reason why I hesitated to jump into eBay at the time, I think they were like $40 and I had the opportunity to do it right here. I decided not to because I do not think they have an economic moat, especially once Facebook rolled out an integrated marketplace into their system and platform. I was like, wait, hold on. So Facebook, you're charging people for advertisements, but also now you're selling products on your website. And I'm like, that infrastructure, I would rather go with Meta. But eBay itself, I still think it's a really good business operation. And they're just benefiting the tailwind of the consumers gravitating towards buying secondhand used products. So I'm really happy for eBay and what has happened to them. Personally, I wouldn't want to buy them at $100 and whatever dollars per share, even though the numbers and the financials look pretty good. I mean, the free cash flow growth is absolutely bonkers. And from my understanding, a lot of the resellers, the people that go to Goodwill and thrift and then flip it online, a lot of them are gravitating away from eBay and they're going on to different apps like Depop, Poshmark, Vinted, and some others because the fees that eBay are charging are getting ridiculous. So that is something to be mindful of. But because of those fees, I mean, their numbers are ridiculously good. So it's a double-edged sword. You don't want to charge too much of a fee that shoos away all of the merchants because then your network effect diminishes. But in the short term, I still think eBay has a bright future. Long term, I feel like Facebook is the ultimate winner. And then there's Cisco. They're basically the ones that provide all the frozen food to most restaurants, in which the restaurant will then reheat that food and serve it to the customers. That's what Chili's does. And there's also Kenvue, which used to be a part of Johnson & Johnson. And Kenvue is responsible for selling the consumer health products at the pharmacy store, such as Neosporin when you get a cut, Band-Aids, stuff like that. And they're supposed to be swallowed up by Kimberly-Clark later this year. I think Kenvue is a really good one. I kind of regret not buying the dip back in October. I was really busy because this is when my daughter was born, but it's okay. You live and you learn, and there were other opportunities in the market. And then I want to talk about this one, Kroger. They are the biggest standalone grocery chain in the US. The biggest market share is actually held by who? Walmart. I think 1 out of 4 Americans do their grocery shopping at a Walmart. But Kroger, they only do groceries, and they're starting to integrate their own factories to manufacture and sell their private label goods. Kroger, I really like. Albertsons could also be a part of that conversation, but not as much. And the grocery landscape as a whole, when I think about Sprouts Farmers Markets and Natural Grocers by Vitamin Cottage, which is a company that I did a deep dive on just for the Patreon family, which is a lesser known all organic natural grocery chain that's really small. Their footprint's not that big, but I love that their target demographic, they're not trying to reach everyone. They're only trying to reach the health conscious people and the affluent crowd that only want to buy organic stuff. But anyways, when I think about the grocery landscape, Albertsons, they reported their earnings about, I want to say 2 or 3 weeks ago, and they went on record by saying that the consumers are gravitating more towards Aldi, Lidl, Trader Joe's, and Walmart instead of the traditional grocery modality of going to Kroger's, or Albertsons, or Ralph's, or Vaughn's, or Food Lion. And by taking a look at their dividend profile, a 10% dividend growth rate, 2.7% yield, I think there's a lot to like about Kroger's. But then again, if you guys remember the exclusive Patreon research that I shared on this channel not too long ago, if we're going to be talking about and investing in groceries, because that's something we need to sustain life, right? The physiological needs, that's what I'm most bullish on. Water, food, shelter. If you don't have that, you can't exist. And when we think about that, I would personally rather go with Walmart, Amazon, because they own Whole Foods, Costco. When I think about Kroger, they're in a distant tier 2, which right? Like if you have the option to go with tier 1, you might as well go with tier 1. Having said that, though, I think Sprouts and the Natural Grocers Vitamin Cottage, I think they're tier 1.5 because their target demographic tend to skew for the higher discretionary spending and the higher social economic status crowd. Whereas with traditional grocery stores, I think they're just trying to cater towards the everyday American, and they really do not have an economic moat. It's what's stopping them from doing the bulk of their shopping at an Aldi and then picking up the random spice that Aldi doesn't have at an Albertsons, which means their transaction per basket for Albertsons or for Kroger, it's going to be a lot less. So that's where my brain is at. By the way, you should give that video a watch because I spent so much time doing the research for that, and it was only supposed to be for Patreon, but I shared that level of research for free for everyone so you could see what's on the Patreon itself. So Kroger, I really do like, but if I were to jump into them, I would need a far fatter margin of safety to compensate for the fact that the consumers are deviating away from traditional grocers to going to discounted grocery stores. So like, I know a 10.8 is a really low forward PE, but for me to be able to swallow that risk, to take on this type of investment, which I do like, I think they're high quality, I would at least need to see like a 6 or a 7. And I say that because the grocery store chains, they actually trade for a really low valuation because if you take a look at their P&L, their profit margin is really razor thin, just like Walmart. I think Walmart only pockets less than like 3% when you take into account all the transactions and all the money that they make. Likewise with the grocery stores, exact same thing. And their profit margin is a 0.7%. So if they make $100, they're only profiting 70 cents after you take into account taxes and everything else and overhead costs. But I digress. If we jump on over to the ratios tab and we take a look at their forward PE, actually I stand corrected. I think at a 10.8, historically it's on the low end for their valuation. It's usually around, I would say it shakes out to around a 12, and right now it's a 10.8. So I think if Kroger's forward PE goes down to like an 8 or 7, or did I say 6? 6, 7, or 8, like I said earlier, I think that's when I would give them a fair look. And I think for that to happen, they would need to drop to at least like $49, $48 per share. By the way, give me your feedback and let me know if you like this type of video or content, because if you don't, I don't have to do it again. But if you love it, this is something that I would totally be down to do on a cadence, like maybe every 2 weeks or every quarter, so once every 90 days or something like that, because I think it's kind of fun to see who's actually undervalued according to the fundamentals, not just on the stock price. We'll do one more. There's Zoetis, pharmaceutical just for farm animals, dogs, and cats. There is Otis Worldwide, Elevator Operation, which I really do fancy. I really like them. There's Dollar Tree, Ulta Beauty, and then I guess we'll do Columbia Sportswear Company. Forward PE being a 14.9, 14.5% ROIC. First two I like. Free cash flow growth, 25%. There's a lot to like here. So basically they own the brands that are very specific to outdoor living, hiking, and adventures, right? I think what's their portfolio consist of, like the brands? I want to say it's Columbia, Mountain Hardwear, Prana, and Sorel. And if you take a look at their stock price history, 12% year to date, so pretty much in line with the S&P 500. Past 5 years, atrocious. What is going on here? Negative 45%. Yikes. Numbers look to be a little stagnant, I would say. No, probably more accurate to say slightly shrinking since 2022. It looks like they're making a recovery now because their free cash flow is making a modest improvement year over year. And I guess that's bound to happen once it shrinks freaking 26% and then 50% year over year. Now, once you hit that valley, they're going back up. But if you take into account their free cash flow back in 2021 at 319 million, and the fact that it's now 321 million, when you blur out the noise and take into account what happened in 5 years, pretty much flat. So by reading between the lines, I can tell that Columbia, I mean, the clothing might be high quality, but the numbers inconsistent, which is to be expected by an apparel retail manufacturer. The exact same patterns are experienced by Under Armour, same with VF Corporation. They'll all see very similar ebbs and flows. Which for Under Armour, this is disgusting. What is going on right here? VF Corporation is the parent company of North Face. You pick any one of them blindly, and they're all experiencing the same stuff. And so my whole thing is if you're going to invest into a clothing brand that sells shoes or shirts, you got to know when to jump ship with the profits. I do not think they are a buy and hold compounder because their time to shine might be today, and tomorrow they might be irrelevant. I'm saying it right now. I could be wrong, but that's what I've seen and experienced. Like, if you take a look at American Eagle, take a look at their renaissance and comeback and then fall. This is a company where, do you see what I'm saying? Highs and lows, and it's reflective of their free cash flow. There's highs, there's lows, there's highs, there's lows. And I think this trend is a commonality across the board from Nike to Decker to American Eagle because none of them have an economic moat that prevents the competition from doing what they are doing, such as making running shoes, such as making hiking shoes. Anybody can do it, right? And that's why the economic moat is that freaking important. And something else that I want to address while you're sitting there dropping your poop in peace, it's this. I do not believe in timing the market. I think there are some people that sit on the sidelines with cash as they watch the stock market rally to all-time highs. That couldn't be me. On a macro level, I'm always investing. I'm always buying or selling nearly every single week. But having said that, I absolutely believe in the notion of timing my specific purchases into individual stocks because I do not do ETF or index investing. I pick and choose individual companies, the winners of the bunch. So if you take into account a specific industry like medical devices, I will pick the highest quality, best in class, rather than going for number 7 or number 8. And in that case, it's Abbott Laboratories. And the reason being as to why I time my purchases is because on a micro level, I only like to buy when a compounder is on sale. If they're not on sale, I don't want to buy into you because the upside to their inherent worth, it's not there. So to buy into them when they're overvalued, what I get is asymmetric risk to the downside. So here's my little pitch. If you want to stay up to date on my real-time buys and sells, feel free to join the Patreon. If the price of a pizza is too much, don't worry, because I also share the information through the public portfolio series, and I have to upload another episode. I have to do it. Anyways, I love you guys. Hopefully you learned a thing or two, and please do participate in the comments section. Stay safe, and I will talk to you guys next time. And good luck in the stock market. See ya.